Hello guys, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the 50 moving average strategy, a method that has proven to be highly effective in identifying trends and making precise entry and exit points in the forex market. Whether you are new to trading or looking to refine your strategy, this is a technique you will want to master. By the end of this video, you will have a clear understanding of how to use the 50 period simple moving average to spot profitable opportunities and to avoid common pitfalls. Stay with me until the end of this video and you will learn how to apply this strategy with confidence in your own trade. Let's get started. First of all, we have to understand what a 50 moving average strategy is all about. Let's dive into understanding the 50 moving average. The 50 moving average is one of the most reliable technical indicators that can that can be used in your trading arsenal. Think of it as a line that shows the average price of a currency pair over the last 50 period, helping you to see the market direction more clearly. When you look at your chart, the 50 moving average acts as a dynamic support and resistance level. This means that it can help you identify areas where price might bounce or reverse from. The key strength of this indicator lies in its ability to filter out market noise while still being responsive enough to catch significant price movement. As you can see from the screen, this is the 50 moving average. You see, it is actually showing us that this is a bearish market. You can see it's showing us the direction of the market, that the market is trending towards the downside. Now let's look for a bullish scenario. This is the 50 moving average in a bullish scenario, and it can show you that the market is trading towards the upside. Now this 50 moving average also help you to avoid false signals that short term moving averages might not help you to avoid. Like let's say the 20 moving average, which is too fast, which can give you a lot of fake signals. Or you look at the 200 moving average, which is too slow and might make you miss out on a lot of good trading opportunities. Let's look at an example of let's look at an example of the 20 moving average. Now the 20 moving average, let me change the color so that it will not confuse anybody. I'll change the 20 moving average color to yellow. As we can see, the 20 moving average is too fast and it's inside price. It will be difficult for us to read the price action with 20 moving average. Now let's check the 200 moving average. While I change the color, let me put the red color. Look at the 200 moving average. As you can see, it is too far. It can make us lose a lot of good trading opportunities because it is too big. It is too big and it's a bit far from price to get a good price action reading. So that's why we prefer to use the 50 moving average because of this strategy. Now let's know how we can apply the 50 moving average strategy. The key to success with this strategy lies in understanding three main components. The first one is to identify your trend. The second one is your entry point, and the third one is your exit point. First, let's look at the trend identification. When price is trading above the 50 moving average, we would say that we are in an uptrend. As you can see, price is trading above the 50 moving average, shows that we are in an uptrend. If you use your trend line, you would also see clearly that this is an uptrend, as you can see with your trend line, however you want to draw it. When it comes to a bearish market, we can see we have to look at the reversal. When price is trading below the 50 moving average, it shows that we are in a bearish market. As you can see, price is trading below the 50 moving average, and it shows that we are in a bearish market. So now, for entry points in an uptrend, we have to wait for price to pull back and touch the 50 moving average. When price bounce off this level, it often presents a high probability buying opportunity. We have to look for extra confirmation though. Confirmations such as candlestick pattern. Let's look at this for example. When price bounce off this level, since price is trading above the 50 moving average, when price bounce off this level, this particular level, for us to take a trade here, we have to look for our candlestick pattern. We can see a pin bar here, but it's not that convincing. Even if you would want to take this trade from this pin bar as it bounce off the 50 moving average, you will just need to set your stop loss to below the previous swing low you can see. Then you target your 1:3, 1:2 reward ratio, however you choose. Let's look for another example. When price bounce off this level, we will look for our candlestick pattern. As you can see, I can see a bullish engulfing candle, which signifies that price really wants to reverse from this area. We take our trade from the engulfing candle, put our stop loss below. We can put it below the previous swing low, or you can put it at 20 pips at most, and you target 1:2, 1:3 risk to reward, as the case may be. Now let's look for a bearish example. Bearish example, when price is trading below the 50 moving average, we wait for price to retest the 50 moving average. When price retest, as it retested here, we will look for our trading signal, our signal to sell the market. If you look at this area, I wasn't seeing any convincing entry signal, any good candlestick pattern, until I saw this bearish engulfing candle, which signifies that yes, price is really ready to fall from this area. I entered the trade and I put my stop loss above the previous swing high. This is the previous swing high, or swing lower low, or lower high rather. So let's not forget that we target our 1:2 or 1:3 risk to reward ratio, as the case may be. Let's look for another example of a bearish trade we can take using the 50 moving average. Okay, let's look at this area. When price came to this place and retested the 50 moving average, we can take the trade from this area because we can see some rejections here, and we can see a bearish engulfing candle at this area. If we see this bearish engulfing candle, we can decide to take our trade here. We put our stop loss above the previous swing, previous lower low or the previous lower high. Then we target our regular 1:2, 1:3 profit target. That's it. We can also take profits from previous swing lows. We can target from previous price action. We can target previous swing lows where price have reacted from, or we can target support or resistance areas where we believe price might reject from. Areas such as this. In the case of this trade, we can target areas like this, which is 1:2, as the case may be. The real power of this trading strategy comes from its simplicity and reliability. You are not trying to predict the market movement. Instead, you are following the trend and using the 50 moving average as your guide for higher probability trades, entries and exits. Alright traders, we have come to the end of this video. Engage with us in the comment sections below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on your notification bell so that you won't miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.